Do crypto assets have any value? The problem is, when we ask this question, we try to compare crypto assets with securities like stocks and bonds. Unless a crypto asset is backed by other assets, it cannot be compared with securities because it doesn't pass the Howey test. The Howey test defines a security or investment contract as a transaction where money is invested with the expectation of profit from other people's efforts. In case of crypto assets, it is not true. So, is there any source of value for crypto assets? And if it is true, then what are those sources? Let me ask you a question. What is the source of value of a dollar or a yen? As fiat currencies are not backed by any asset, there is not much intrinsic value associated with currencies. So, what is the source of value of a currency? And if there is no value, then why governments and investors keep on piling them? It is because currencies allow us to participate in specific economies where the currencies can be used to avail goods and services. Now coming back to crypto assets, the value of non-asset backed crypto assets is tied to the economies these crypto assets allow us to participate in. Say, for example, in the case of metaverse projects, the crypto assets can be used to play games or procure virtual real estate. As in the case of fiat currencies such as dollar and pound, the value of a crypto asset is tied to the economic system this asset gives access to. And the discipline which deals with designing and defining economic value of crypto assets or tokens is called tokenomics. Tokenomics deals with designing economic incentives for procuring, holding and trading crypto assets, which ultimately leads to higher market value of the ecosystem the crypto asset gives access to. Now, before we talk more about tokenomics, let's talk about different types of tokens. Tokens can be classified into payment tokens, utility tokens, and asset tokens. Payment tokens are synonymous with cryptocurrencies and are majorly used for payments. Utility tokens are tokens which are intended to provide digital access to an application or service. Asset tokens represent assets such as participations in real physical underlyings, companies, or income streams, or an entitlement to dividends or interest payments. In terms of their economic function, the tokens are analogous to equities, bonds, and derivatives. Now, the above mentioned token types are use cases for fungible tokens, tokens which have identical value. Non-fungible tokens or NFTs can have unique value for each token. The major use case for NFTs is as collectibles. Now, asset tokens and NFTs represent value of some underlying asset. We are left with payment tokens and utility tokens. In this video, we will talk about a broad framework to value these tokens. We will cover a framework created by Burniske, who is a crypto researcher and partner at the venture capital firm Placeholder Ventures, and Jack Tatar, managing partner of Doyle Capital. The framework is based on monetary equation of exchange. Let us start with equation of exchange. The equation of exchange is a mathematical equation for the quantity theory of money in economics. The equation forms a relationship between money supply and GDP of the economy. The equation of exchange was derived by economist John Stuart Mill. The equation states that the total amount of money that changes hands in an economy will always be equal to the total monetary value of goods and services that changes hands in the economy. MB equals to PT. M is the money supply or the average currency units in circulation within a time period. V means velocity of money or the average number of times that a currency unit changes hands within a time period. P equals to the average price level of goods and services during a time period, and T equals to the index of real value of all aggregate transactions within a time period. So the left hand side says the total amount of money that changes hands in an economy, and the right hand side says the total monetary value of the goods and services that changes hands in the economy. Now coming to Burniske and Tatar framework, MV equals to PQ. M equals to the size of the asset base, V is the velocity of the asset, P equals to the price of the digital resources being provisioned, and Q equals to the quantity of digital resources being provisioned for the platform. The left hand side of the equation signifies the token value that change hands in the ecosystem, and the right hand side signifies the transaction value of the resources for which the token is issued in a given period. Now let us try to implement this to an imaginary token which is used for processing payment transactions. Let us assume that the total addressable market in 5 years will be 1 billion transactions of $100 each per year. That is, P equals to $100 and Q equals to 1 billion transactions per year. So P multiplied Q equals to $100 billion worth of transactions per year. Now let us assume that the token has a velocity of 5, that is, on average, one token changes hands 5 times per year. We arrive at a potential market capitalization of 100 billion per year divided by 5 per year equals to $20 billion. Now if we divide the number 20 billion by the number of tokens which will ever come into circulation, say 10 million, we get a number $2,000. We have assumed that this kind of market activity will be achieved in 5 years, and we can discount $2,000 by an appropriate rate and arrive at an estimated present value for the token. Now this is a very simplistic example. There are various complexities in real life which make the computations much more difficult. So let us talk about some of these complexities. One major complexity is the calculation of velocity. Consider, for the imaginary token, total transaction volume in a year equals to 50 billion, and the average market value of the token ecosystem in that year equals to 10 billion. So velocity equals to 50 divided by 10 equals 5. This calculation infers that each token changed hand on an average 5 times in that year. In reality though, a part of the token supply was locked in wallets of holders and staked in liquidity pools. So the velocity of the remaining portion of the token supply, which was in float, was much higher than 5. So to really implement the model, we need to calculate a hybrid velocity which adjusts the velocity for locked up tokens. The second complexity is the uncertainty over the actual number of tokens which will be in circulation. This uncertainty leads to further complexity in calculating velocity. Now, some crypto assets have defined max supply, but many crypto assets do not. Some crypto assets are pre-mined, where some do not. Some crypto assets have defined issuance schedule, some do not. Some crypto assets are burnt, which creates a deflationary pressure, whereas some crypto assets are perpetually inflationary. Apart from this, lost private keys, yield farming, etc., create added complexity in estimating actual number of tokens which will be in circulation. Now, the previous two uncertainties were related to the supply side of the equation. The third uncertainty is related to the demand side of the equation and to the growth of the ecosystem. Let us consider the payment example we talked about before. For the payment example, the demand side of the equation consists of P, the average price of transactions in that period, and Q, the number of transactions in that period. But while implementing the equation, we are projecting P and Q. This projection involves making estimates about the future market size, competitiveness of the platform, competition landscape, etc. There are many variables here. Valuation of crypto assets is complex for various reasons. We are at a very early stage of the technology and the ecosystem is still evolving. The goal of any framework is not to come up with precise valuation for crypto assets, but rather help us think about the value drivers for the crypto assets. And it is not only important for analysts and investors to think about these value drivers, but also for the creators who are building the crypto platforms. This will help them align the economic incentives so that participants will be encouraged to hold and trade in those crypto assets. With this is Sam Ghosh. Thank you very much for watching. Bye-bye.